Zoom Video Communications reported its fiscal 2027 second quarter earnings after the market close on August 25, 2026. The headline numbers looked strong at first glance. Total revenue finished above the top end of the company's own guidance. Non-GAAP earnings per share came in at $1.55, beating Wall Street consensus of $1.4752 across 26 analysts by about 5%. Enterprise revenue saw its strongest growth rate in 3 years. Yet despite beating its own targets, Zoom stock fell roughly 5% in after-hours trading. The reason for the market's skepticism becomes clear when examining the details of the income statement. The massive bottom-line surge this quarter was not driven by core operational growth, but rather by an extraordinarily large non-operating gain from strategic investments that has to be separated from the underlying business. Looking closer at the core operational results, total revenue reached $1.2772 billion, up 4.9% year-over-year, or 4.7% in constant currency. That was comfortably above the company's prior guidance cap of $1.27 billion. Enterprise revenue rose 7.8% to $787.5 million, representing 62% of total revenue. Large enterprise accounts contributing over $100,000 in annual recurring revenue grew 8.2% to 4,625 customers. Remaining performance obligations expanded 14% to about $4.5 billion, with the non-current portion up 25%, marking its strongest growth in years. On the capital allocation front, Zoom repurchased 3.7 million shares for approximately $352 million, bringing cumulative buybacks under its program to $3.4 billion, with about $1.3 billion remaining in authorization. Cash and cash equivalents stood at $7.2 billion. However, underlying operational profitability showed signs of compression. Non-GAAP operating income was $510.3 million. While that met guidance, non-GAAP operating margin landed at 40%, coming in below the targeted 40.3% and dropping from 41.3% reported a year ago. The central story of the quarter lies in the non-operating line items. Zoom recorded net strategic investment gains of $1.6142 billion in the quarter. That compares to $152.3 million in the previous quarter and just $45.1 million in the same period last year. On the balance sheet, strategic investments ballooned from $1.5786 billion at the end of January to $3.7859 billion, even though cash purchases of investments year-to-date totaled only $441 million. This massive unrealized gain pushed GAAP net income to $1.5424 billion, or $5.15 per share. By comparison, non-GAAP net income was just $464 million, or $1.55 per share. Stripping away this investment gain reveals that Zoom's core operational metrics actually went backwards. Non-GAAP net income declined year-over-year from $471.3 million to $464 million. GAAP operating income dropped from $321.7 million to $314.3 million. Free cash flow fell from $508 million to $472.4 million. Interestingly, management never identified the specific underlying asset driving this $1.6 billion gain during the conference call, and not a single Wall Street analyst asked about it. In the online segment, average monthly churn improved slightly to 2.9%, compared to 3% last quarter and 2.9% a year ago. The chief financial officer noted that the company's historical low for churn was 2.7%, placing the current figure within a normal baseline. Customer retention among long-term users strengthened, with clients of 16 months or longer now accounting for 75.6% of online monthly recurring revenue, up 70 basis points. Furthermore, a price increase of about 6% introduced on the online business in mid-March did not trigger any noticeable customer attrition. Despite these stable churn figures, management officially lowered its full-year online revenue assumption from slight growth to flat. The downgrade was attributed entirely to top-of-funnel acquisition challenges. Management reported an industry-wide shift in consumer behavior as prospective customers increasingly use artificial intelligence search and discovery tools rather than traditional web search engines to evaluate software products. Online revenue for the quarter rose just 0.6% to $489.7 million. At the same time, Zoom's financial disclosures around artificial intelligence monetization left investors without a precise revenue figure. Management explicitly declined to quantify direct revenue from artificial intelligence offerings. Asked when they might disclose a specific annual recurring revenue milestone for the contact center business, executives stated they would provide updates periodically at their discretion rather than at fixed intervals, suggesting analysts infer progress from secondary data. They also confirmed they do not intend to break out revenue from the recently acquired community platform product. Instead, the company offered several proxy metrics. Management highlighted that contact center annual recurring revenue is growing at a high double-digit percentage rate, supported by multiple seven-figure annual recurring revenue deals. 9 of the top 10 contact center deals signed in the quarter included paid artificial intelligence features. Virtual agent customer accounts grew 256% year over year. The WorkVivo employee communications product crossed $100 million in annual recurring revenue, while Zoom Phone annual recurring revenue expanded in the mid-teens percentage range. Notably, Zoom stopped disclosing the number of paid seats for its AI companion assistant this quarter, after having reported 184% seat growth in the previous quarter. Enterprise net dollar expansion stood at 99%, up from 98% a year ago but unchanged from the prior quarter. Management reaffirmed its goal to push expansion back above 100%, but cautioned that white-label churn will present a stronger headwind in the second half of the year. White-label churn created a 60 basis point drag on enterprise growth this quarter and is expected to represent a 40 basis point drag for the full year. The executive Q&A session featured 9 distinct analyst exchanges. Samik Chatterjee of J.P. Morgan asked about the composition of record seven-figure enterprise deals and how management plans to navigate gross margin pressure from rising artificial intelligence compute costs. Management responded that contact center growth continues at a high double-digit rate, driven by upmarket share gains and artificial intelligence attach rates. On gross margins, management explained that recent expense increases reflected a spike in compute usage for new products, which they plan to optimize in the second half while leveraging a federated model architecture to maintain long-term 80% gross margins. Peter Levine of Evercore asked how much growth runway remains for Zoom Phone within the workplace installed base and whether contact center deals represent net new customer wins or upsells. Management answered that Zoom Phone continue to win against both legacy on-premise and cloud competitors, noting that 10 of the top 10 phone deals involved competitive takeouts and 5 included contact center capabilities. They added that contact center is increasingly pulling in standalone new logos directly alongside expansion across the existing user base. Elizabeth Porter of Morgan Stanley asked how product adoption balances between new customer acquisition and existing expansion to drive net dollar expansion above 100%, while also inquiring about the strategic contribution of the Common Room acquisition. Management clarified that enterprise growth of 7.8% is being driven by product diversification across phone, contact center, and artificial intelligence, supported by lower churn. They noted that Common Room represents an early-stage acquisition integrated into their go-to-market strategy, though its financial contribution relative to the broader $5 billion revenue base remains de minimis. Siddhi Panigrahi of Mizuho asked about the competitive environment in contact center against major software and artificial intelligence vendors and how virtual agent tools are being sold. Chief Executive Eric Yuan explained that Zoom differentiates itself through an integrated architecture combining unified communications, contact center, and virtual agents backed by proprietary speech recognition and low-latency models. Yuan emphasized that virtual agents are sold both as standalone offerings to non-Zoom customers and bundled directly into broader contact center suites. Ryan McWilliams of Wells Fargo inquired about trends in the online small business segment following price increases and how enterprise customers are utilizing Zoom data gravity for customized artificial intelligence workflows. Management explained that the adjustment of full-year online guidance to flat reflects broader changes in top-of-funnel product discovery from search to artificial intelligence engines, rather than underlying churn. Yuan added that Zoom enables enterprise clients to access their contextual data layer across external large language models while offering integrated capabilities through ZoomMate. Patrick Walravens of Citizens asked about the technical implementation, realism, and operational setup required for companies to train customized voice avatars based on management's earnings presentation demonstration. Management noted that setting up personalized artificial intelligence avatars requires minimal setup time with human-in-the-loop oversight. Yuan added that the latest iterations leverage updated voice and video models with the long-term strategic objective of enabling interactive avatars to assist in routine communication tasks. Tyler Radke of Citi asked when management will provide specific revenue milestones for Zoom Contact Center and what factors drove the reduction in full-year capital expenditure guidance. Management stated that milestone updates will be shared periodically rather than at fixed revenue thresholds, noting that contact center remains a key component of enterprise expansion alongside lower overall customer churn. On capital expenditures, management explained that the $40 million reduction, which directly supported the full-year free cash flow raise, resulted from extending data center asset useful lives by 2 years. Alan Verkovsky of BTIG asked about seat growth trends across enterprise accounts and requested details on the key drivers behind the full-year revenue guidance raise. Management replied that enterprise customer churn trends continue to improve year over year, while online churn remains stable within historical ranges. They reaffirmed that the revenue guidance update incorporates sustained enterprise expansion across core products alongside the inclusion of Common Room, while maintaining a conservative outlook on the online segment. William Power of Baird asked about cross-sell opportunities for Workvivo following its $100 million milestone and how investors should reconcile the full-year revenue guidance raise against second quarter performance. Management highlighted that Workvivo serves as a strong acquisition vehicle that frequently lands in accounts that do not currently use Zoom's core video products. Regarding guidance, management noted that while enterprise execution remains strong, the full-year revision reflects a prudent adjustment to account for flat online growth and second-half white-label churn headwinds. Looking ahead, Zoom outlined guidance for the third fiscal quarter, forecasting revenue between $1.275 billion and $1.28 billion. That represents year-over-year growth of just 3.9% and implies virtually flat sequential performance. This modest near-term outlook served as the primary trigger for the stock's after-hours sell-off. For the full fiscal year, Zoom raised its revenue guidance to between $5.085 billion and $5.095 billion. It increased its non-GAAP earnings per share guidance to a range of $6.08 to $6.12, up from the previous range of $5.96 to $6.00. Full-year free cash flow guidance was raised to between $1.78 billion and $1.82 billion, up from $1.70 billion to $1.74 billion, though management acknowledged that roughly $40 million of that increase stems from capital expenditure cuts rather than operational expansion. Non-GAAP operating margin targets for the full year remained unchanged at 40.7%. Notably, the size of the full-year revenue raise is smaller than the magnitude of this quarter's beat. signaling expected deceleration in the second half of the year. Following a regular trading session, drop of 3.73% to close at $100.92. Zoom stock declined an additional 5.04% in after-hours trading to $95.83. The quarter highlights an ongoing tension for investors. Core revenue growth remains stuck at roughly 4%, with compressing operating margins, while the primary booster of headline profits was an undisclosed non-operating investment gain.